Welcome, everyone, to today's Explainer. Today, we're launching a full-blown investigation into something that absolutely baffles business owners and professionals everywhere. We're going to put our financial scorecards under the microscope, specifically the income statement, and figure out exactly why those numbers printed in black and white might actually be deceiving us. Let's decode this thing together. So, here's the million-dollar question that hooks pretty much everyone. Why does the net profit you see on paper rarely, if ever, match the actual cash you have sitting in the bank? Seriously, you look at your statement, it says you made this massive profit, but then you log into your bank account and, well, the money just isn't there. Are your books lying to you? Is someone skimming off the top? Or is there just a completely different language being spoken here that we need to learn how to translate? Well, let's solve this mystery. Okay, let's dive right into this. Take a look at what pretty much everyone considers the ultimate scorecard, the statement of profit and loss. Notice how beautifully structured it is. It tracks your sales, deducts the cost of those sales to give you gross profit, and then subtracts a whole laundry list of expenses right down to that shiny final net profit figure at the bottom. It really looks like a cash tracker, doesn't it? But actually, it's kind of an illusion. This document doesn't track your bank vaults. It tracks financial performance based on some very specific accounting rules. To figure out where the actual cash went, we need to examine three main suspects that are totally responsible for this massive gap between your paper profit and your reality. All right, let's meet suspect number one, the time shifters. So these time shifters are essentially foundational accounting rules that manipulate our timeline. And the real mastermind pulling the strings here is something called the matching principle. This principle dictates that we figure out our profit by matching costs with their associated revenues in a specific financial period, entirely regardless of cash movement. Read that last part again for me, regardless of cash movement. Basically, your income statement is plotting out a financial timeline of when value is earned or consumed, completely ignoring when the cold hard cash actually entered or exited your business. Crazy, right? To see how this time shifting actually plays out in the real world, let's contrast two everyday scenarios. On the left, we've got accrued expenses. These are expenses you've racked up but haven't actually paid for yet. Think of them like financial time travel. They drag a future cash payment backward into today's profit calculation, which lowers your net profit even though your bank balance hasn't dropped a single cent yet. Then, on the right, we have prepaid expenses. This is when you've paid cash out of the bank today, but you haven't actually used up the thing you bought. Well, the matching principle steps right in and hides that cash you spent from your current profit. So your bank balance takes a hit, but your profit stays looking great. Moving right along to suspect number two, the invisible thieves. These guys are the silent expenses that ruthlessly eat away at your reported profit without a single penny leaving your bank account today. And the best example of this invisible thief is depreciation. It's basically an invisible wear and tear tax. Look, when you buy a non-current asset, like a delivery truck or a heavy piece of machinery, you don't just record that massive purchase as a day one expense. Instead, you slowly consume its value over its useful life. Whether it's physical factors like rust and decay, economic factors like the tech becoming totally obsolete, or even time factors like a lease running out, that asset is bleeding value. That lost value hits your income statement as an expense, lowering your profit, but you definitely aren't writing a new check for rust every year. Now, our second invisible thief is honestly fascinating. It's known as the provision for doubtful debts. In the real world, let's face it, not every single credit customer is actually going to pay you. People go bankrupt, businesses shut down, or sadly, people pass away. But accounting doesn't just sit around and wait for the absolute worst to happen, it anticipates it. By creating a provision for doubtful debts, we take a preemptive hit right to our income statement. We're literally recording an anticipated loss as a current expense. It is a highly intelligent, conservative way to measure your business health, but again, it completely suppresses your net profit on paper while your actual cash sitting in the bank remains completely untouched. And finally, that brings us to suspect number three, the shapeshifters. These are flat-out accounting errors, and it's wild how well they disguise themselves. An error of omission simply means a transaction completely vanished. It's just missing. An error of commission is when you post to the wrong personal account, like say you accidentally bill M. Patel instead of J. Patel. But check out the error of principle at the bottom. This is a game changer. This happens when a transaction is posted to the completely wrong class of account. Imagine taking a $200,000 cash purchase of a motor vehicle, which absolutely should be logged as a non-current asset, and accidentally recording it as a standard day-to-day purchases expense. Your cash drops, obviously, but your profit on the income statement, It is artificially and instantly slaughtered by $200,000. So here is the absolutely crucial takeaway. You might pull up your trial balance, see that the debit and credit sides balance perfectly down to the decimal, and think, great, everything is perfectly accurate. But that, my friends, is the trial balance trap. Because double entry math was technically followed in those shape-shifting errors we just talked about, the books will balance perfectly. But the underlying profit being reported on your income statement could be hiding a massive, massive lie. Which brings us right to the climax of our investigation. If our income statement is being shifted by time, robbed blind by invisible expenses, and potentially totally distorted by shape-shifting errors, how do we ever bridge the gap between this distorted financial document and the actual, undeniable reality of the cash sitting in our bank? We need a serious tool to reconcile these two parallel universes. Enter the ultimate detective's tool, the bank reconciliation statement. This is exactly how we hunt down the truth. By cross-referencing your internal cash book against the cold, hard external reality of your bank statement, you can hunt down every single discrepancy. It forces you to update your books with those silent bank charges or auto-renewals you completely forgot about. It catches those misposted deposits. But most importantly, its main job is to mathematically explain the exact penny-for-penny difference between what your books say you have and what the bank actually says you have. It forces accounting and reality back into perfect alignment. So, what is the grand resolution to all of this? Well, after tracking down the time shifters, the invisible thieves, and the shape-shifting errors, the truth is actually pretty simple. The income statement isn't maliciously lying to you. It's really not. It's just speaking a completely different language. It's speaking the language of earned value and consumed resources. It exists to smooth out the jagged, highly unpredictable reality of cold hard cash to give you a much truer picture of your long-term operational health. Which leaves us with one final, incredibly important thought to ponder as we wrap up this explainer. The very next time you pull up a statement of profit and loss, I really want you to ask yourself, are you truly reading your profit with a clear understanding of all the matching principles, the depreciation, and the accruals working behind the scenes? Or are you just frustratedly trying to count your cash? Because once you learn to finally separate the two, the mystery completely disappears and your true financial fluency begins. Thank you so much for joining me, and keep learning.